Welcome to the Explainer. So, when you think about investing today, what comes to mind? Probably an app on that smartphone sitting right in your pocket, right? But modern investing absolutely did not appear overnight. It actually emerged from more than a century of innovation, shifting from this incredibly exclusive club to something literally at our fingertips. And to really understand how we got here, we're going to take a close look at the story of one company that became an absolute giant in America's financial landscape: Fidelity Investments.
But before we really get going, we've got to bust a pretty major myth. You'll often see the year 1871 thrown around as the founding of Fidelity, but honestly, that's a total misconception. That earlier date kind of just conflates modern Fidelity with much older predecessor entities. The reality is that the story of the modern investment powerhouse actually begins quite a bit later, in 1946.
1946. That's the exact year we're anchoring to today. That's when a man named Edward C. Johnson II founded Fidelity Management and Research over in Boston. And this right here is the true beginning of our narrative, starting with one family and one highly ambitious idea about how money should actually be managed. All right, here's our roadmap for this explainer. We're going to cover the true founding year, the post-war investment boom, research and family leadership, the brokerage digital revolution, and finally, investing in the modern era. Let's kick things off with Section 1, the true founding year, myth versus reality. To really appreciate what went down in 1946, we kind of have to set the scene. Back in the early 20th century, American capitalism was booming. Corporations were expanding, and stock markets were actively raising a ton of money. But for the ordinary American, Wall Street might as well have been a completely different planet. It was distant, it was overly complicated, and it was dominated almost entirely by ultra-wealthy individuals and massive institutions. If you were just an everyday person trying to build some wealth, the barrier to entry was astronomically high. Moving right along to Section 2, the post-war investment boom. Enter the middle class. So, to fix this huge problem of Wall Street basically being a VIP-only club, a really powerful concept started taking hold: pooled investing. Think about it. Rather than you sitting all alone at your kitchen table trying to pick and buy individual securities by yourself, you could invest alongside thousands of other people through a professionally managed mutual fund. It's a brilliant solution because it gave ordinary people the exact same diversification and professional management that previously only the ultra-wealthy enjoyed. And this specific idea, it would become absolutely central to Fidelity's entire business. And honestly, the timing couldn't have been better. Fidelity jumped in at the exact right historical moment. After World War II, we saw factories producing at this enormous scale. Consumer demand was going right through the roof, and American household wealth was steadily rising. People were buying homes, corporate America was expanding fast. Pension plans became the norm. For the very first time, millions of everyday Americans actually had the means to adopt a long-term savings mindset. It was basically a perfect storm, allowing the mutual fund industry and Fidelity to expand right alongside everyday American families. Next up is Section 3, Research and Family Leadership, the Fidelity Philosophy. So, founder Edward C. Johnson II laid out an investment philosophy that basically boiled down to 3 straightforward but incredibly powerful steps. 1. Research companies carefully. 2. Identify opportunities. And 3. Manage investments with a long-term perspective. Having this kind of disciplined, structured approach applied directly to an everyday investor's portfolio, that was completely revolutionary at the time. They were essentially doing all the heavy lifting for the middle class. And it really all hinged on this one crucial idea: understand the businesses behind the securities. You see, Fidelity didn't want its analysts just blindly following market trends. No, they built an intense research culture. Their analysts actually went out and examined the companies. They studied earnings, evaluated the management teams, looked at the competition, and assessed long-term growth. They did the vital homework, and that obsessive, research-driven approach is exactly what built their reputation. Now, this also turns into a major family story. When his son, Edward C. Johnson III, took the reins, he aggressively expanded the business. They didn't just sit back and stay a mutual fund company. Under his leadership, they moved way beyond traditional funds. They developed brokerage services, created retirement products, and even introduced financial planning. They essentially transformed into the massive, comprehensive financial services giant whose products you likely use or at least recognize today. That brings us to Section 4, the brokerage digital revolution. Power to the investor. This era brought a massive shift that completely flipped the traditional financial model on its head. In the 1970s, brokerage commissions finally began falling, and new technology made telephone orders so much easier. Then, in the 1990s, the personal computer arrived, meaning faster financial data, automated portfolio management, and eventually, internet trading right from your living room sofa. And today, you are managing entire, complex financial portfolios via the smartphone in your hands. Fidelity embraced this digital transformation at every single step, moving from analysts and physical paperwork to a highly technology-driven platform. And I think this brilliantly highlights that crazy shift in power. The old way, it completely relied on a traditional, gatekeeping stockbroker who basically held all the cards. But the new way, which Fidelity actively helped pioneer by expanding its brokerage business, was all about giving you, the investor, the actual tools to manage your own portfolio. It was a massive transfer of control, moving power away from Wall Street insiders and handing it directly to Main Street DIY investors.
Finally, Section 5. Investing in the Modern Era. Main Street's Wall Street.
Just look at the sheer scale of the financial landscape today, and more importantly, look at who it actually empowers. You've got digital investing tools empowering individual investors. You have incredibly robust retirement plans empowering everyday savers and massive employers alike. And you have institutional management handling the complex needs of huge organizations. From a global institution all the way down to a single person planning their retirement at their kitchen table, the modern financial ecosystem is built to serve absolutely everyone. At the end of the day, the barrier between Wall Street and ordinary investors has literally never been smaller. Think back to where we started in 1946. A distant, exclusive, highly restricted financial world. Because of pooled investing, the post-war boom, structured research, and a massive technological revolution, investing just doesn't belong solely to the professionals anymore. It lives in our ordinary homes, right on our laptops and on our phones. So I want to leave you with a thought to chew on. Now that the barrier to Wall Street is practically gone, how are you going to participate? You've got the tools, you have the access, and hopefully after this explainer, you've got a much better understanding of how this incredible democratization actually happened. The power is literally in your hands. Thank you so much for joining me to explore this fascinating history, and I'll catch you in the next explainer.